Hi guys, welcome to the channel. My name's Zek. You're going to hear me introduce myself again in a minute, but that's because I forgot to say, please smash the like, please like and subscribe, smash the notification, smash the bell, ring-a-ding-ding, let's get into the charts. Right, let's go. Okay, something like that. Okay, welcome to the channel. My name's Zek. So we've had a little bit of a small pump with Zcash, made it up to $143. I didn't really trust in the strength of that rally. It looked like it was coming up to test the 200 moving average on the 2-hour chart, and it does indeed seem to be well. It's not that surprising that it seems to have run out of steam, because Bitcoin itself is sorry, this is not the one. This is the Bitcoin chart I want to look at. Bitcoin itself is sort of looking a little bit like it has run out of steam, and it's Zcash taking its cue, as most of the alts will, from the Bitcoin price. I wanted to look at the today. I wanted to look at the accumulation phase that we're in. I think the Wyckoff accumulation phase is pretty much going according to how I have been envisaging it might. I wanted to look at the Bitcoin. I thought I'd show you something that happened in September. If we look back to, so this is the current Bitcoin price on a 12-hour chart, and let's just make it look larger so you can see, as I'd been saying previously, and I've put this onto a hollow candle chart. It gives us a little bit. It's a little bit easier to kind of see what's going on than the line chart that I was using before. And I've redrawn it to kind of to fit a bit better with this this chart. Now look, we can see back in May, when we first had the the big sell-off. We can see that this probably is the preliminary support that the Bitcoin found here, up at kind of 46,000. That kind of ties in quite nicely with some of the other things we were talking about yesterday. Anyhow, then look, the selling climax down here at 30,000 round about there, and we know that the if you were trading it at the time, the automatic reaction, or the automatic response of the short covering and the large players, the institutions buying up the supply at these bargain prices, took the price almost straight away back up into the 40,000s, and this defined the trading range, the accumulation trading range we're now in, between these upper boundaries and these lower boundaries. Now, I have been a bit uncertain as to the time frame over which this accumulation is going to take place. I've been thinking it will be long, over the days, weeks, and even months, rather than really a shorter time frame, and therefore I didn't really agree with looking at this on the 4-hour chart. When you look at it on the 4-hour chart, it seemed fairly obvious that this point here that we've had recently, this low down at 31,000, was probably the spring, and that we are now heading up toward, this would be the last point of support, and so on. But I don't think that. I think that we are seeing this transpire over a longer period. For one thing, looking at it on the daily chart, it makes perfect sense with this as preliminary support. The selling climax here, automatic response, and then the secondary test, the first secondary test being this one. Now, the reason I'm fairly becoming more confident that this is the case is that I found a little found another example that we can look at. This is on the Bitcoin chart, but this is on the logarithmic. I'm looking on the logarithmic scale, and this is back in September. Now, so in September, when the price was, well, it had been on the 2nd of September, $12,000, and we saw a similar look. We saw a very, very similar. This is almost like we're looking at the same chart. Let's zoom out a little bit. We could be looking at the same thing. Look, there's one. This is September, and then here is, this is now. But the difference is this is on the 12-hour. This is on a one-day chart, and this in September is looking at it on the 4-hour. Okay, now back in September, we did have, I mean, maybe we could say this wasn't the preliminary support. Perhaps that's the preliminary support there. There we are. Now, as you can see, we have preliminary support, selling climax. The price is down to under 10,000. Automatic reaction. You can see very clearly from this wick, this huge wick, that this was just clearly short covering and a huge appetite from big players who wanted to snap up all of the supply at this price, and this defined the accumulation trading range here. Now, then a secondary test at just under 10,000. This is the secondary test in phase B. Here we have, there we are, sorry. It's a bit easy to see now, sorry. So here's the secondary test in phase B. We have the spring test, and then show of strength up here, and so on, and you know, the accumulation phase is over. And after this is when Bitcoin kind of went on that turbo bull run to sort of first to 20,000 and on to 60,000 in the new year. Now, but the interesting thing here is that this took place over the preliminary support. The first wave of selling starts on the 2nd of September, and we're past the show of strength is done and over by the 14th. So this is like a 2-week period. Okay, so it's appropriate to look at this on the 4-hour chart. It accumulates over 2 weeks, and although you do have another chance to buy another dip back here, quite clearly, as far as I can see, quite clearly, this is the I mean, we could argue maybe this phase, maybe phase D and maybe phase D and E could stretch out a little bit longer, but basically, and you could maybe say that this is the last point of support. But what's the difference? I mean, if you're buying it here or if you're buying it here, this is the last chance that you get to buy the 10,000 or anything like it, and after this, it's off to the races for Bitcoin. So and like now, you know, and even now that we've hemorrhaged 50-60%, we're nowhere near that. So this really, when you're talking, you know, last point of support, this is last chance saloon to snap up the bargains, and this is why these big players are falling over themselves to soak up the supply down at this point here. But the point that I wanted you to notice was that the almost everything is the same, except the time frame that this takes place over, and so I think if we were to look at our current But this isn't. This is our current accumulation chart, or where we're currently at, and the first wave of selling is the 12th of May, and we're now 5 weeks from that point, nearly, and we're clearly not at the end. I mean, perhaps I'm wrong, and perhaps we are at this is perhaps the show of strength, and it kind of would make sense. But from the way I'm looking at this, I'm just not convinced. If we look at the point with these Wyckoff accumulation zones is that if it's an accumulation zone rather than actually just a little bounce on a broader decline, then if we're assuming this is all about accumulation, then what are the guys that know what they're doing trying to achieve? Well, what they're trying to achieve is to soak up the circulating supply, and to do so at the most at the lowest price possible. And it's obviously all about supply and demand, and we need to try to understand supply and demand by looking at these charts. Now, the first thing to notice if you're trying to establish supply and demand is you want to see the price spread, and you want to look at the price spread and the volume of at any given time. And as we can see, look, after this preliminary support gives way, look at this is, by the way, this is back in September. Look at the price spread here and the volume. Huge selling volume and huge price spread. Now, we could look between here and here, maybe, or we could just look at, okay, so here, if we go from here all the way down to, if we measure from where the preliminary support breaks down to the selling climax, we have an 11% spread in the price, and a huge volume, okay, and so we know that we can infer from this that the retail customers are spooked. Everybody's heading for the exits, and the large interests are only too happy to soak up the supply from these panic selling, weak-handed retail investors, and so they do. And this triggers this, along with the short covering, triggers an automatic reaction, or automatic rally, automatic response, which defines the trading range, the resistance levels at the top of the trading range here. Now, following which, large interests and institutions will ensure that they're net buyers of this particular asset, but they will also be selling in order to push the price back down. They'll be buying and selling, on balance, always being a net buyer in order to accumulate, but gradually pushing the price back down to test this lower boundary again, and to help to further define the trading range. Now, and this as this takes place in phase A, this is known as the secondary test of the lower levels, and we can see here that, and what we want to see, if you're an institution or you know a big participant, Wyckoff called this the composite man. If you are the composite man, you want to test the supply of the shares or the asset, in this case Bitcoin, and what you're testing for is again trying to establish the supply. You know the demand, you want it, but you want to establish how much supply is still there, and so again, we should measure the spread in price, and here we can see that it's significantly diminished, the supply. The spread is 4%, 4.5%, as opposed to 11.5% in the first wave. We can see that the volume is reduced, but there's still a lot of selling volume, and that's still a pretty whacking price spread, as you can just see by the candle itself. And for this reason, we have the next phase in which the composite man effectively does the same thing. The large interests are still testing to see how much supply there is for them to snap up at bargain prices. They don't want this accumulation period to be over until the price spread is negligible, or is as small as possible. And obviously, it's not one person doing this. This is a various institutions, various large interests. But the point is that they're all acting in their own interest, and their own interest is the same, and their own ability to be net buyers of vast quantities of this asset enables them to collectively and individually manipulate the price within this trading range, and at this point towards the lower end, because they want to again establish the floating supply. And so look, we see it reduce again. The price spread here is is this the one we just did? No. So here we're down to just under 3%. Here, the spread between the top of this candle and the tippy toe bottom. So you can see again. So this is like less. This is a quarter maybe of the original huge spread that we see here. And for that reason, they know that they can tell that the retail. The supply that is available to be snapped up from the panicking, weak-handed retail investor is greatly diminished. They go into phase. We pass into the phase C, and there is one final test, which will be known as the spring. And the point, according to Wyckoff, is that you should see the spring should test just below the lower boundary of the trading range, and you can see that it does in this September example of this accumulation period. We can see that this candle here wicks down just below the boundaries I've drawn. Well, the boundaries that are there according to the price action at the time. The lower boundary, it's just below to 9,800. So absolute bargain prices, but for the composite man. But the composite man has established here that he's exhausted most of the supply. In fact, actually, the price spread is slightly greater there, but still 3.5%. It's greatly diminished from the initial huge wave of selling. And so there's the final test of this lower boundary. And then we move into phase D, and so I think that we could compare what happened at this point before that, because effectively this was the last big sell-off in Bitcoin before Bitcoin went on the absolute bullish rampage that we've seen over the last almost year, well, 3/4 of a year, and I believe that we're only really halfway through this bull cycle, and in the last bull cycle, similar, you saw similar price action, and it is not uncommon. I think it was in 2013 we had the exact in the 2013 Bitcoin bull cycle that we actually saw a pretty identical phenomenon of this kind of two two phases to the cycle. The first, and then a huge dump, a huge correction around about the middle of the year, followed by another enormous upswing. Now, it won't always be the same, but maybe it might rhyme. And so I think it's worth looking at this, which preceded the autumnal raging bull of the Bitcoin of this cycle's Bitcoin activity. We can compare this to what's happening now, which could be like in 2013, could be the middle of, could be the only the middle of the phenomenon. And so I think let's go back to this is the current. This is back to present day, and we're on the daily. And again, so now if we look at the spread between where it broke the preliminary support, and it's enormous here. We have like a 35% price spread between here and here. Now, I mean, maybe we should only be measuring, but even that is almost just the one candle. I've kind of done it from here. Maybe I should have done it from here. But let's say 35%. Now that's the initial selling climax. 35% with a huge volume candle here, and we establish this trading range in phase A as the automatic reaction. And I remember it. I mean, I remember shorting Bitcoin here, and I was whooping because it was a wonderful feeling shorting this. And taking profits, only to see this enormous bounce back to where you'd effectively started. That was happy days, but it was again short covering and these large interests snapping up the absolute bargain basement price from all these weak-handed retail investors. Classic Wyckoff. And just as in the previous example in September, we see this automatic reaction followed by another test of the lower end of the trading range. But here we want to see lower volume, there will be less volume, but we want to see how much they want to establish. The composite man wants to establish how much supply there still is of this asset. And look, but there is still 18%, a spread of 18%. In this candle on its alone, and this, don't forget, this is on the daily. This is taking place on the daily time frame, on the daily charts. The previous one was on the 4-hour and taking place over a much shorter time period. As I say, this is 5 weeks we're in here, and so from the preliminary support on the 18th of May to the candle we've just measured. Is what day is that? That's the 21st. This is taking place over half of the entire accumulation zone in the previous example. But here we have the preliminary support. We still have an 18% price spread between At the same point, we were halfway through the accumulation cycle in September, but here there's still an 18% spread in price, and still a huge amount of volume selling this asset to the composite man. So I think that gives an indication of where we are at that point in the accumulation period. And then again, now I previously had using the I'm not even gonna, but using the line chart, I was actually calling this another secondary test. I think it's not. I think looking at it on this chart, I think this is just trading within the range. This is just what Bitcoin is volatile, and it's just doing that. It tests the top end again. I think what we've recently experienced was the secondary test in phase B, and it comes down and tests the very bottom of this. And again, let's measure the. So let's measure the spread. Now I think we could either I would be also. I have actually looked at this on a 2-day chart, and it makes sense on the 2-day chart. And if we were looking at this on the 2-day chart, I think we would use both of these. We would use both candles. We'd measure both candles rather than just one. And on both, if we look at both of these two candles here, we've still got a 16% price spread at this during this last test of the 30,000 boundary. I don't know about you, but I don't think the composite man will infer from this that he has yet exhausted the floating supply from the weak-handed retail investor, and so that would indicate to me that we haven't yet that this is not the spring. I mean, I could be wrong, and we could just measure the one candle here, but there's still nearly a 9% spread on the daily in that price, and I think in either case I don't quite buy that implies that the floating supply is sufficiently exhausted as to deter those greedy, avaricious institutions from pushing this asset back down to the lower end of the trading range for at least one or two more tries at the lower support of the trading range. I mean, look, this would make perfect sense. It would make perfect sense if we were to have at least one more try down here, and that would tie in with. Also, the other thing is, look, the price doesn't really drop below the lows of the previous trading range. So even if you called this the secondary test, this. Well, I suppose if you called this a secondary test, you could argue that this maybe was the spring, but I don't really think it qualifies. I think that we need the price to come down again and test these levels. Then we'll experience potentially the spring, and we can move into phase C and D. But particularly due to the fact that, as I was pointing out yesterday, that the weight of the daily EMA ribbon and the daily, I think it's the daily 200 moving average, it's all coming crashing over. I've taken it off at the moment. Let's get our EMA ribbon back on for you. There we are. It's just, look, we can see what's happened. I explained yesterday. Look, it doesn't work like this. It's unlikely that after this huge move down and this degree of accumulation, it's unlikely. You would need to see some incredibly big volume, buying volume coming in to bring on the daily chart to bring this for the price action to have any hope in hell of busting straight through this EMA ribbon in one fell swoop. It makes much more sense for us to test it and to fail, and what's happening is the bots, the algos, the composite man they've sold into this first effort to this first delve into the daily EMA into the daily EMA ribbon, and I think now what happens is we're driven back down for another test of the lower end of the range, and maybe that's the spring. Maybe we carry on with more for longer even than that. But certainly I don't think we want to be anticipating that this is the moment to take out an enormous leveraged long on the Bitcoin price, because there's just too much potential downside. It's much and don't take out leveraged longs at any point, because there's no need. It's like there's just no need. All you need to do is to buy this asset without any kind of leverage. Just buy it now and hold it forever, because even if you buy it here and keep it for 10 years, you're going to be laughing. Or if you're looking over shorter time frames, I really think you're going to be rewarded for holding fire, even if I'm wrong, and this is in fact and this was the spring, then you will still get a chance to accumulate Bitcoin at 37,000. So you could look, ladder in, buy some at 36 or 37,000. It's coming down already today, and buy some at 36, 37,000. Be ready to buy some more when it comes down to 31 or 29,000 or wherever it pops down to for the spring. But I really do think that you are going to be rewarded for biding your time, for keeping your powder dry, and keep something in reserve in USDT or in some stable coin that you can snap. Be the composite man. Wait and see evaluate what the price spread is at every stage of the testing of these lower boundaries. And if you see it coming in to 2, 3, 4%, then maybe you can start to infer that the floating supply has been absorbed by the large interests, and it's time for you to absorb some of it yourself. In anticipation of the second half of the turbo raging bull, which is imminent, and yeah, I think that's probably what we need to all be doing. That's pretty much all I have to say for today. Let's see quickly again what Zcash doing. Yeah, Zcash. It just wanted to touch up to there, didn't it? I just think with Zcash as well, I take my cue from, I would load up on Zcash, guys. I haven't done a video on why you need to, but do a bit of research yourselves, read about Zcash. If you think that Bitcoin is interesting, Zcash is even more so, and you should certainly have some exposure to that. I think the asymmetric returns are even greater than with Bitcoin. If Bitcoin is coming for another test of the 32,000 range, then certainly Zcash is coming down in kind, and we're probably coming down below 100. I think with Zcash. Maybe there's a chance that Zcash will actually hold above 100, as it may be that the market infers from Bitcoin's own decline that there is a lot more effectively sideways action of accumulation, and that could, as I've previously said, that could give us a little a sort of mini alt season. Maybe not a mini alt season, maybe a massive alt season, depending on how long the Bitcoin accumulation takes place over. But again, I don't think there's any need. There's certainly no need to use leverage. Maybe there's no need to try to pick the bottoms on especially with these altcoins. If you can see what Bitcoin's doing, it becomes fairly straightforward to infer what that might mean for some of these alts, especially something like Zcash, which is so correlated to Bitcoin, and then there's no need for you to get in on the bottom. When these things are giving you a 20-30% pump in a day, you only need you only need to make a bit of a gain on each of these every now and then. I mean, when you compare this to trading equities or trading anything else, or any other way that you might have of making money, like being a salaried employee or running your own business, the percentage gains that you can take from all of these digital assets is phenomenal by comparison, and they're traded 24/7, non-stop. So you can, with a little bit of commitment, you can make a nice bit of wonga from trading the volatility. So yeah, I think that is pretty much me. So look at it coming down. Okay, excellent. Well, happy hunting. Good luck, and And I've been reading about quantum computers and the threat they may pose to Bitcoin. What I will say to you all is they don't pose a threat to Bitcoin, but they do pose a threat to anyone's funds, anyone's crypto funds, for anyone who is not using the appropriate level of caution. That is to say, and I think I might make a separate video about this because it's so important. I mean, I've been absolutely reckless myself on this, and I can't believe I've only just actually taken note. But see, the point about quantum computing is that although it's very embryonic, quantum computing. Actually, look, I'll make a separate video. But first, this is the point: do not reuse your any Bitcoin address. Once you have a Bitcoin address, and probably this goes for any crypto address, is as long as it's one of the newer addresses of the newer format, not the original ones from like 2010. A Bitcoin address is uncrackable, unstealable, uncrackable by a quantum computer. Certainly the quantum computers that are in existence or soon to be in existence. It's uncrackable and your money is safe if you have never sent funds from your Bitcoin address. So let's say you create a wallet on your Coinbase or your Trust Wallet app or whatever it may be. If you create a new wallet and then send funds from your exchange or from wherever you've bought them to your Bitcoin wallet, the funds are safe. They're absolutely safe because no information has been revealed on the public blockchain about your about the actual public address of that wallet. However, as soon as you send any 1 Satoshi from that address, as soon as you spend 1 Satoshi or send 1 Satoshi to another address of yours, the way that the technology works is that this reveals your public address, not your private key, but your public address. And the problem is that quantum computers running a certain algorithm, even the quantum computers that currently exist, can use your public key to derive your private key. And so as soon as your public key is revealed on the blockchain, because it will be in order to make a payment from your address, this will give you only a number of hours, possibly something like 10 hours. It would take a quantum computer to calculate, to crack the code, literally to crack the code, to break the. There's an algorithm which can calculate it probably in about 10 hours. The private key for your Bitcoins, and so you really must not make any payments from the from this new address. The key thing would be to make a payment, i.e. to send all the funds somewhere else to a new address, and then you will be safe. But I mean, because the Bitcoin blockchain, for a transaction to be confirmed, usually it should take about 10 minutes. So if you make a transaction from your Bitcoin address to another address, to your own address, and you send your funds from one wallet to another, then in 10 minutes the transaction will be confirmed. And your funds will be moved to a new address which has not ever been revealed because you've made no payments from it. It's never been revealed on the blockchain, and so your funds will be safe. But if you were to send, let's say, $50 worth of Bitcoin from your Bitcoin wallet, and then leave the rest of the funds in your Bitcoin wallet, potentially a bad actor using a quantum computer, potentially a bad actor could use that quantum computer to seeing your public address on the blockchain, it could use the quantum computer to then calculate the private key from your public key, and within 10 hours, if you leave your fund, the balance of your funds in there, within 10 hours, it's then possible for them to make a transaction of their own on the Bitcoin blockchain using your private key and your and to take the funds away from you. So very, very, very important. And I don't actually quite like the implications of this. So I'm going to make another video in more depth when I've read more about it. But yeah, be aware. This is an issue. Okay, good stuff. Happy hunting. Ciao, ciao.